Picture this. Your alarm goes off. Normal morning. You reach for your phone to check your balance before you even get out of bed. And the screen just shows a message, account suspended. That is not a hypothetical. That is exactly what millions of Argentinians experienced in December of 2001. One morning, the government froze every bank account in the country. People couldn't buy groceries. They couldn't pay rent. Money they had spent decades earning was just locked away behind a screen. Now here's the question I want you to sit with. If that happened in your country tomorrow, not eventually, tomorrow, what do you have outside of that bank that keeps your family fed? The people who lost everything in Argentina weren't careless. They weren't reckless spenders. They just had all their eggs in the one basket everyone told them was safe. The people who came out ahead? They had positioned their money in the right places before the system cracked. That is exactly what this video is about. Today on Atlas News Report, we're counting down the 10 assets that have consistently protected wealth through every major economic crisis in documented history, ranked from least to most powerful. And stay with us until the end, because asset number 1 is one the financial system actively hopes you never think about. Before we get to the list, here's why this conversation matters right now, not in 5 years now. 3 data points. First, the United States national debt crossed $33 trillion in 2024. That is more than the entire annual economic output of the country. Every single dollar the U.S. produces in a year wouldn't cover what it already owes. Second, in October of 2024, the International Monetary Fund released a formal warning about global public debt levels, calling them the highest they've been since the end of World War II. The IMF doesn't use language like that without reason. Third, real estate markets across multiple cities in Latin America and Spain are showing the same pattern indicators that flashed before the 2008 housing bubble burst. The same signals, the same trajectory. These are not opinions. These are documented data points from global financial institutions. The question was never if another crisis will happen. The question is whether you'll be positioned correctly when it does. That's where these 10 assets come in. Every one of them has a documented track record of surviving real crises, not theoretical ones. Let's start the countdown. Asset number 10, agricultural commodities. Strip everything away. Remove the stock market, the cryptocurrency, the real estate speculation. Strip all of it away, and what's left? Food. In every single economic crisis in recorded history, people stopped buying cars, they stopped buying vacations, they stopped buying luxury goods, but they never, not once, not anywhere, stopped needing to eat. During the Great Depression, crop prices for corn, wheat, and soybeans spiked because while production was disrupted, demand never went away. During COVID in 2020, the United Nations Food and Agriculture Organization reported that average prices of basic food commodities rose 22% globally, 22%, while the rest of the economy was in freefall. You don't need to start a farm to access this. Agricultural commodity ETFs, exchange-traded funds that track food staple prices, trade on stock exchanges just like company shares. When food prices surge in a crisis, as they always do, your position reflects that. This is asset number 10 because while it's reliable, it's the least dynamic on the list. But it belongs here because the logic behind it is as old as civilization. Asset number 9, hard currencies. Not all money holds up the same way in a storm. When a local economy collapses, its currency collapses with it. But certain currencies have a documented pattern of getting stronger when panic hits because the entire world runs to them for cover. The US dollar is the primary example. When global fear spikes, investors flood into the dollar. It happened in 2008. It happened during COVID. The dollar is the world's reserve currency, and in a crisis, everyone still wants it. The Swiss franc is what finance professionals call the fear currency. Switzerland hasn't been involved in a war in 170 years. It runs the most conservative banking system on earth. When the rest of the world destabilizes, the franc holds. The Japanese yen rounds out the classic trio. Historically, it strengthens in periods of global uncertainty. Ray Dalio, founder of Bridgewater Associates, the largest hedge fund in the world, recommends holding between 10 and 15% of your wealth in hard currencies as a basic hedge. Given current U.S.-China trade tensions and ongoing tariff uncertainty, the dollar's position as the world's safe harbor has only been reinforced. I'll say this now and repeat it throughout. The goal of this list isn't overnight wealth. It's making sure what you built over decades doesn't disappear in weeks when something goes wrong. Asset number 8, real estate in high-demand zones. Real estate has one of the longest survival track records on this list, but it comes with one condition that most people skip over completely. Location isn't just important, it's everything. The clearest example, during the 2008 financial crisis, properties in Las Vegas lost 80% of their value. Properties in Manhattan dropped about 15% and recovered fully within 3 years. Same crisis, different cities, completely different outcomes. Why? Demand. In places where people consistently want to live, work, and build businesses, land never permanently loses its foundation value. The people always come back. Here's what most investors miss. You don't need to buy a whole property. REITs, real estate investment trusts, trade on public exchanges and let you participate in real estate returns starting from small amounts. Right now, there's a specific trend worth watching. Nearshoring, the movement of manufacturing from Asia into Mexico, is creating a historic surge in demand for industrial and residential real estate in northern Mexican cities like Monterrey, Saltillo, and Reynosa. That kind of structural, demand-driven real estate play is exactly what holds up in turbulent markets. Asset number 7, silver. Silver has something gold doesn't, a dual identity. It's both a precious metal and a critical industrial material. That combination gives it a layer of resilience that's unique on this entire list. Silver goes into solar panels, it goes into electronic chips, electric vehicle batteries, and medical equipment. In practice, that means if the economy crashes hard, silver rises as a safe haven asset the way gold does. But if the economy recovers quickly, silver also rises because industrial demand surges back at the same time. The historical data backs this up. In 2008, silver fell with everything else. But from 2009-2011, it climbed nearly 400%. 400%. That is one of the most dramatic recovery trajectories of any asset class in that entire period. And looking at the current environment, global energy transition is accelerating, solar installations are scaling up, EV adoption is expanding. Silver is a core component in both of those trends. That demand isn't slowing down. You can buy physical silver in coins or bars through specialized dealers. It's one of the most accessible, tangible assets on this list for everyday people. And every asset you're hearing about today has a documented record of surviving real crises. Silver is no exception. Asset number 6, businesses that sell what people can't live without. In every economic collapse in recorded history, certain businesses don't just survive, they grow. And the pattern is always the same. It's not the luxury brands, it's not the tech startups, it's the businesses selling what people cannot cut from their lives, no matter what the economy is doing. Basic food, medications, healthcare, home repair services, even funeral homes genuinely counter-cyclical because that particular type of demand never decreases. Warren Buffett, most analysts consider him the greatest investor in history, has said repeatedly that his favorite investments are in companies selling products people buy repeatedly and inevitably. That's not coincidence. It's a philosophy built from decades of watching what survives when everything else falls apart. The practical application. If you run a business or are planning to start one, the most crisis-resistant sectors are food production, pharmacies, hardware stores, affordable healthcare clinics, and laundromats. People walk into those businesses during recessions the same way they do during boom times. And if you'd rather invest than operate, publicly traded consumer staples companies have one of the strongest documented records of maintaining value in downturns. This is the Buffett approach, and it has more data supporting it than almost any other investment strategy in history. Asset number 5, Bitcoin and digital assets. I want to be precise here because this category gets distorted constantly in both directions. Bitcoin was created in 2009, directly after the 2008 financial collapse. It was explicitly designed as an alternative to a banking system that had just demonstrated it could fail spectacularly. And in the years since, something significant has happened. Bitcoin has begun behaving like a digital version of gold in the portfolios of institutional investors. There are 21 million Bitcoin that will ever exist. That number is coded in. No central bank can print more. No government can inflate it away. In countries that have experienced currency collapse, Venezuela, Argentina, Turkey, Bitcoin adoption surged because people needed a store of value that existed outside the broken local system. Bitcoin is volatile. That's a real fact. In 2022, it lost over 60% of its value before recovering to new all-time highs. The key is position sizing. Most analysts who include crypto in a defensive portfolio recommend treating it as the high volatility, high upside component. A 3 to 5% allocation gives you asymmetric upside without excessive exposure. What places this at number 5 instead of higher is its relative youth compared to gold and real estate. The track record is shorter. But the structural argument, fixed supply, globally accessible, government independent, is one of the most compelling new entries in the crisis protection conversation. Asset number 4, dividend-paying stocks in essential sectors. Think of this as the institutional version of asset number 6. While owning an essential business directly gives you operational control, owning shares in publicly traded companies that do the same thing gives you liquidity, diversification, and income, even when markets are turbulent. The key word is dividends. Companies that pay consistent dividends, especially in utilities, consumer staples, and healthcare, tend to be financially disciplined, cash-generating operations. They've prioritized returning money to shareholders through good markets and bad. Here's the historical anchor. During the Great Depression, while the overall market lost 89% of its value between 1929 and 1933, companies like Procter & Gamble, which sold soap, detergent, and basic household products, recovered dramatically faster than the broader market. Why? Their customers never stopped buying the product. The strategy is straightforward. Essential sector companies with pricing power in inflation and stable demand in recession. Utilities, food manufacturers, pharmaceuticals, household goods. They hold their position and keep generating income while everything else is uncertain. A dividend-focused essential sector portfolio won't make you rich in a bull run, but it's the financial equivalent of a storm shelter when conditions deteriorate badly. You're still standing and still getting paid. Asset number 3, raw land. There is one thing they genuinely cannot manufacture more of: land. We covered real estate in high-demand urban zones earlier. That's about location-driven property value in established markets. Raw land is a different concept. It's the acre-level boundary line ownership of physical ground. And in a genuine systemic crisis, it is one of the most durable stores of wealth that exists. Here's why. In a deep financial collapse, paper assets can become worthless. Digital assets can be frozen or heavily regulated. But a deed to physical land held in your name in a jurisdiction with property right that survives nearly everything. Throughout history, families that preserved wealth across generations almost always held land. In crisis-era Europe, in post-war Latin America, in economic collapses across Asia, land consistently served as the foundation that everything else was rebuilt on. Raw land near growing infrastructure corridors, in agricultural regions, or adjacent to expanding urban boundaries, tends to hold value and appreciate over long horizons. It generates no income on its own. That's the trade-off. But for the portion of your wealth that needs to be crisis-proof above everything else, very few things in history have done it more reliably than physical ground with a clear title. Asset number 2, gold. There is not a single documented economic crisis in human history where gold permanently lost its value. Not one. Not in thousands of years of recorded financial history. During the Great Depression, while the U.S. stock market was collapsing by 90% between 1929 and 1933, gold held its purchasing power. When the American government adjusted the official gold price in 1934, gold holders actually saw a 30% increase in value. During the hyperinflation that destroyed Germany's economy in the 1920s, wheelbarrows full of paper currency weren't enough to buy a loaf of bread. But 1 ounce of gold was enough to purchase real property, physical property. That's not a metaphor, that was the actual exchange rate. In Venezuela over the past decade, as the bolivar became functionally worthless, The people who held gold preserved their wealth. The people who held local currency watched decades of savings disappear. And here's something that should stop you cold. In 2024, the International Monetary Fund reported that central banks around the world purchased more gold than at any point in the previous 55 years. Let that land. The institutions that print money, the very people who run the monetary system, are aggressively buying gold. That does not happen by accident. What does this tell us? It tells us that the people with the most information about the global financial system are quietly hedging against it. When central banks move that way, in that volume, it's a signal worth taking seriously. How do you access gold? You can buy physical gold coins. The Mexican Centenario is one of the most widely recognized in Latin America, with a transparent market price. You can buy gold through exchange-traded funds that track the metal price. Or you can look at gold mining company stocks, which tend to amplify gold's moves in both directions. Most wealth managers recommend holding between 5 and 10% of your portfolio in gold as a baseline hedge. Not your whole portfolio, 5 to 10%. That's enough to meaningfully protect your position in a crisis without overexposing you to an asset that doesn't generate income. Gold is number 2 on this list, not number 1. Only because of what comes next. Because what comes next is the one asset that no crisis in history has ever been able to destroy. The one asset no government has ever been able to confiscate, and the one asset that actually grows in value the more freely you give it away. Asset number 1, your specialized knowledge and skills. Here's the truth. The financial system has no interest in you ever discovering. You can lose your cash, you can lose your house, your investments can be wiped, your accounts can be frozen, your portfolio can go to zero. Every single financial asset on this list, the gold, the silver, the real estate, the Bitcoin, can be taken from you, regulated away, inflated into worthlessness, or destroyed in a crisis. But there is not a government, a bank, a central authority, or a market crash on Earth that can reach inside your mind and extract what you know how to do. Think about the Great Depression. Who survived it best? Not the speculators, not the stock market players, the doctors, the plumbers, the experienced farmers, the mechanics, the people who had skills that their neighbors needed regardless of what the Dow Jones was doing. Skills are the only asset that becomes more valuable during a crisis because crisis creates desperate demand for people who can solve real problems. During COVID in 2020, LinkedIn published data showing that professionals with digital skill sets, social media marketing, programming, digital design saw a 43% increase in job opportunities during the pandemic. 43%, while entire industries were contracting sharply around them. Robert Kiyosaki writes in his book that the most powerful asset any person owns is their mind. Trained correctly, it can generate extraordinary wealth in a very short time frame. But here's what makes this number 1, above gold, above real estate, above everything else on this entire list. It's the only asset that compounds when you give it away. You can teach what you know. You can package it as a service. You can turn it into digital content that generates income from anywhere in the world. A person who can solve a specific real problem better than most other people can monetize that expertise globally from their kitchen table. Accounting, home repair, healthcare, technology, languages, culinary arts. Whatever domain you have developed genuine depth in, that is your most crisis-proof asset, bar none. And the return on investment for building that knowledge, through education, through courses, through mentors, through deliberate practice, beats every other asset on this list over a long enough time horizon. Every single one. You cannot outsource the building of this asset to a brokerage. You cannot buy it in an ETF, but nothing on earth can take it from you once you have it. Let me bring this out of the abstract with 3 real situations because data means more when it has a human face. Argentina, 2001. A middle-class family in Buenos Aires had their life savings in the bank. When the government enacted the Corralito and froze all accounts, they couldn't pay for groceries. They were completely paralyzed. Their neighbor had taken a different approach. He had purchased gold and kept US dollars in cash at home. When the freeze hit, he had no problem. And when the crisis caused property values to crater when desperate people were selling at any price just to access liquidity, that neighbor was buying real estate at historically distressed prices. A decade later, that portfolio had grown 4 times over. Same crisis, same neighborhood, 2 completely different outcomes, based entirely on decisions made before the crisis arrived. The Great Depression, 1929 to 1933. The U.S. stock market fell 89%. Entire fortunes were erased in months. But gold held its purchasing power throughout the entire crisis. When the government formally adjusted the official gold price in 1934, gold holders gained 30% overnight, and shares in companies like Procter & Gamble, which sold soap, detergent, and basic household goods, recovered dramatically faster than the rest of the market, because their customers never stopped buying. The crisis happened around them. The demand for what they sold didn't. The COVID pandemic 2020. According to LinkedIn data published in 2021, professionals with digital skill sets, social media marketing, programming, design, saw a 43% jump in opportunity during a period when other economic sectors were contracting sharply. The skills themselves didn't change. The world changed around them in a way that made those skills suddenly non-negotiable. And the people who had invested in building those skills before anyone knew a pandemic was coming were the ones who came out of it stronger than they went in. The same pattern, the same types of assets. Every time, every crisis. This is not theoretical. This is a repeating historical signal. The assets on this list are not trendy. They are not speculative bets. They are the positions that show up again and again on the right side of the ledger when everything else is in chaos. The only question that matters is whether you're positioned in them before the next one hits. Because after it hits, it's too late to make the move. If you made it this far, and genuinely made it this far, not just skipped to the end, you're already operating differently from most people consuming financial content online. Most people will hear information like this, feel a jolt of urgency, and then close the tab and go right back to exactly what they were already doing. Don't be that person. You don't have to build all 10 positions at once. Start with one. Start with whatever is most accessible from where you are right now. A small gold position, a commodity ETF, a skill-building investment in a course or mentor. The compounding starts from wherever you begin, but it only starts if you actually begin. Here at Atlas News Report, we don't cover the noise, we track the signal. And right now, the signals are serious enough that we'd be doing you a disservice by not addressing them directly and plainly. The U.S. debt picture, the IMF warnings, the central bank gold purchases, the real estate patterns. These are not separate stories. They're chapters in the same book. And understanding what that book is telling you, and acting on it before the chapter turns, is the entire point of this channel. If this breakdown gave you something useful, hit like right now. It costs you nothing and it helps this information reach more people who need it. Subscribe if you haven't. Every week we bring you the economic intelligence that helps you make decisions based on data, not headlines. Drop a comment. Which of these 10 assets do you already hold? And which one surprised you most? This is Atlas News Report. We'll see you in the next one.